Okay, let's unpack this. Have you ever felt like you need a secret decoder ring just to understand tax forms, especially when they're not even for you, but for something like an entire estate or a trust?
Oh, absolutely. It's a common feeling. That complexity is real.
Well, you are absolutely not alone in feeling that way.
Yeah.
Welcome back to the deep dive.
And we are truly here to help you make sense of it all, to maybe guide you through what often feels like a labyrinth of rules and regulations.
That's right. Today, our mission is to embark on a deep dive into Form 1041. That's the U.S. income tax return for estates and trusts.
Mm-hmm.
This exploration is really custom tailored for you, whether you're a professional navigating these intricate waters for clients, maybe managing an estate or trust yourself, or, simply incredibly curious about how these unique entities interact with the tax code.
Yeah.
We're going to break down how to prepare this form item by item and really focus intently on those embedded tax-saving methods and strategic opportunities that are kind of hidden within its instructions.
Precisely. We aim to explain not just what needs to be reported on each line, but crucially, why it matters. Provide the broader context.
The implications.
Exactly, the implications behind these rules, helping you grasp those essential nuggets of knowledge. This isn't just about rote compliance.
No.
It's about understanding the profound financial impact of every single decision a fiduciary makes.
So let's begin with the big picture then. Understanding Form 1041. Most of us know the personal 1040 form, right? But what exactly is Form 1041 designed to report, and how is it different?
That's a foundational question. Form 1041 is used by the fiduciary. That's the legal term for the executor, administrator, or trustee.
The person in charge.
The person in charge, exactly, of a domestic decedent's estate, a trust, or even an individual's bankruptcy estate. Think of it like the income tax return for a distinct legal entity, one that has its own life or maybe its own temporary financial existence, completely separate from any individual. And its purpose is quite comprehensive, really covering 5 core reporting areas.
Okay.
Yeah. First, it reports all the income, deductions, gains, and losses of the estate or trust itself. It's its own separate taxpayer.
Right.
Second, it accounts for any income that's either accumulated within the entity for, say, future distribution, or income that is distributed currently to the beneficiaries.
Ah, that distinction sounds important.
It's critical. It impacts who actually pays the tax. Third, it calculates any income tax liability that is specific to the estate or trust as an entity.
Okay.
Fourth, it covers employment taxes if the estate or trust employs anyone, like household help.
Makes sense.
And finally, it addresses the net investment income tax, the NIIT, if that tax happens to apply to the entity's investment earnings.
So that immediately highlights something crucial, doesn't it? Estates and trusts are treated as entirely separate legal entities for federal tax purposes.
Exactly.
Their tax obligations are distinct from the individual who created the trust, or, the person who passed away. That's a fundamental concept to grasp.
It really is.
Almost like they have their own independent financial identity.
That's an excellent way to put it. This distinct legal identity is absolutely foundational to understanding all the reporting requirements and, importantly, the opportunities.
Right.
It's not simply an extension of the individual. It's a new, unique taxpayer in the eyes of the IRS. And misunderstanding this basic point can lead to significant errors.
Okay, so we've established what Form 1041 reports. Now let's get into who exactly is a fiduciary in this context.
Right.
And what kind of estates and trusts are we actually talking about here? It sounds like there's a specific legal definition dictating who files.
Indeed. The term fiduciary, broadly, refers to anyone who holds a position of profound trust and responsibility for the assets of another. For Form 1041 purposes, this primarily means the executor or administrator of a decedent's estate, or the trustee of a trust. Let's systematically break down the specific entities that typically file this form.
Good idea.
First up is the decedent's estate. This entity, it just comes into existence automatically the moment an individual passes away.
Instantly.
Its general charge is temporary but crucial. Gather all the decedent's property. And that means all property, real estate, personal stuff, financial accounts, tangible, intangible, doesn't matter where it is.
Everything.
Then the estate has to pay off any outstanding debts and expenses. Think funeral costs, final medical bills, admin fees, that kind of thing.
Right.
And finally, it distributes the remaining assets according to the decedent's will, or, if there's no will, according to state law. It's really a phase of transition and management, often winding down within a few years.
Okay, that's the estate. What about trusts?
Then we have trusts. We generally distinguish these based on when they're set up. An inter vivos trust is created during an individual's lifetime.
Inter vivos, between the living.
Exactly, between the living. People set these up for various reasons. Manage assets, provide for beneficiaries, maybe plan for future distributions while avoiding probate court.
Common estate planning tool.
Very common. A testamentary trust, on the other hand, is born at the time of someone's death, usually directed by their will. It's part of their estate plan, only coming into effect after they've passed.
Okay.
Now, a critical distinction within trusts is the concept of a grantor-type trust. This one's a bit different.
How so?
Well, despite the trust legally holding assets, in a grantor trust, the person who created it, the grantor, is still treated as the owner of the trust's assets for income tax purposes.
Oh, interesting. So the trust itself doesn't pay the tax?
Generally, no. This
Ah.
happens if the trust document contains certain provisions that give the grantor significant control or benefit, like if the grantor can just revoke the trust, or if they have certain interests in getting the property back.
Right.
So this is a really important point for fiduciaries. If it's a grantor trust, the income and deductions typically just flow directly onto the grantor's personal Form 1040.
Ah.
The trust itself, in this case, usually wouldn't file Form 1041, or if it does, it's often just an information return showing everything flowing out to the grantor.
Okay, that makes sense. So for the trusts that do file Form 1041, what makes them domestic?
Good question. For a trust to be considered a domestic trust, and thus generally required to file Form 1041, it has to meet two specific tests. Think of it like proving its U.S. connection.
Okay, two tests.
Yep, the court test and the control test. The court test means a U.S. court must be able to exercise primary supervision over the trust's administration.
U.S. court supervision.
Right. And the control test requires that one or more U.S. persons, so U.S. citizens or residents, have the authority to control all substantial decisions of the trust.
Controlled by U.S. persons.
Exactly. If a trust fails either of these tests, it could be classified as a foreign trust. And that's a whole different ballgame, often much more complex reporting.
Right, avoid that if possible.
Definitely want to get the classification right up front. It's crucial for compliance and managing complexity.
Okay. What else files 1041?
Finally, we have the bankruptcy estate. Form 1041 is filed for the estate of an individual who is involved in a Chapter 7 or Chapter 11 bankruptcy.
Specifically an individual's bankruptcy.
Yes. This is generally required if the bankruptcy estate has gross income of $14,600 or more for the 2024 tax year. And it's absolutely crucial to understand, again, that the bankruptcy estate is a separate and distinct taxable entity from the individual debtor.
Another separate taxpayer.
Just like the decedent's estate or a regular trust, it must get its own unique employer identification number, or EIN.
Cannot use the individual social security number.
Absolutely not. Never. It reinforces that separate legal identity. And, the individual debtor still has their own separate tax obligations for their non-bankruptcy income.
That's a very clear breakdown of who falls under this umbrella. It sounds like a lot of these entities, especially those non-grantor trusts and estates, share a fundamental characteristic that's central to how their income ultimately gets taxed.
They absolutely do. Estates and trusts are often called pass-through entities.
Pass-through, like partnerships or S-corp.
Sort of like that, yeah. Think of it like a temporary funnel for income, unlike a regular C corporation that pays tax on its own profits.
Right.
Much of the income generated by an estate or trust doesn't always result in income tax liability solely for the entity itself. Instead, the income is typically passed through to the beneficiaries.
Meaning the beneficiaries pay the tax.
Often, yes. They, the individual beneficiaries, rather than the entity, pay the income tax on their share of that income. And this critical process is facilitated by Schedule K-1.
Ah, the K-1.
That's the document the fiduciary provides to each beneficiary, detailing their specific portion of the income, deductions, credits, everything. It's how the tax burden is often shifted from the entity to the individual.
That's a really important concept. It directly impacts the ultimate taxpayer and, how they plan. Now, while Form 1041 covered a lot of ground, I imagine not all entities managing assets or involving trusts use this specific form.
That's right.
Are there specialized entities with their own unique reporting rules, ones that steer clear of 1041 entirely?
You've hit on a critical point. Entity classification is truly the foundational step for tax compliance.
Hmm.
Get it wrong, and you can face significant complications, maybe penalties.
Yeah.
And yes, there are several specialized entities that do not use Form 1041. For example, a charitable remainder trust, or CRT,
Okay.
does not file Form 1041. Instead, it files Form 5227, the Split Interest Trust Information Return. And if a CRT happens to have unrelated business taxable income, it also has to file Form 4720.
Different forms altogether.
Completely different. Then you have common trust funds, typically maintained by banks. These are like collective investment vehicles for trusts.
Right.
They don't file 1041 either. They might use Form 1065, the U.S. Return of Partnership Income, for specific pre-need funeral trusts, one set up to hold funds for future funeral expenses. Trustees can elect to file Form 1041 QFT, specifically designed for qualified funeral trusts.
A QFT form.
Exactly. And finally, qualified settlement funds, often set up for legal settlements like from mass torts or environmental cleanups. They generally file Form 1120 SF, the U.S. income tax return for settlement funds. There's even a special election for QSFs with only one transfer to treat it as a grantor trust, which would involve attaching a statement to a timely filed 1041. So yeah,
Lots of variations.
lots of variations. While Form 1041 is broad, identifying the correct form for your specific entity is always the first, most crucial step for compliance.
That's a perfect segue into the actual filing process itself. Before a fiduciary even dives into the numbers, what's the absolute foundational step they need to take? It sounds like there's a non-negotiable prerequisite.
There is, and it truly is the bedrock for proper preparation. The fiduciary must carefully review a copy of the will or trust instrument.
The governing document.
Exactly, including any amendments or codicils. Think of this document as the precise roadmap, the operating manual for the estate or trust.
Makes sense.
It dictates everything: how accounting income is determined, what distributions are required, all the critical financial aspects and deadlines. It's not just a formality, it's the ultimate rulebook.
Can't skip that step.
Absolutely not. And just for convenience, when remitting tax, fiduciaries are encouraged to use Form 1041V, the payment voucher, especially if paying by check or money order helps processing.
Good tip. And speaking of foundational elements, every tax entity needs an ID number. What about for estates and trusts?
Right. Every estate or trust that is required to file Form 1041 must obtain its own unique employer identification number, or EIN.
Its own EN.
Its own EN. It's a completely separate identity from any individual involved. This is especially vital for a bankruptcy estate of an individual. Remember, the individual debtor's social security number can never be used.
Reinforcing that separate identity again.
Exactly. It ensures distinct tax reporting.
So, EIN acquired, will or trust document, thoroughly reviewed. What about deadlines? When is this thing due? And what if you need more time? Extensions are pretty common.
They are. The standard due date for Form 1041 is generally the 15th day of the fourth month following the close of the tax year.
So April 15th for most calendar year folks.
Exactly. For most calendar year estates and trusts, it's April 15th. If a fiduciary needs more time, they can file Form 7004.
Form 7004.
Right. That's the application for automatic extension of time to file certain business income tax information and other returns. It provides an automatic 5.5-month extension to file the return.
5.5 months. That's pretty generous.
It is. It's a straightforward process, but it's absolutely essential to remember it's an extension of time to file, not an extension of time to pay.
Critical distinction.
Very critical. Any tax due should still be paid by the original April 15th deadline to avoid interest and penalties.
Got it. Pay by April 15th, file by what, September 30th?
Oh, really?
Or October 15th?
5.5 months from April 15th would put you at September 30th.
Okay, September 30th. And where exactly do you send this completed Form 1041? I know the IRS has different centers.
Yeah, the exact mailing address depends on two things: where the fiduciary is located geographically, and whether you're enclosing a payment with the return.
Okay.
For instance, if the fiduciary is in, say, New York or New Jersey, and they are not enclosing a check, they'd send it to Kansas City, Missouri, a specific zip code.
Right.
If they're enclosing a payment, the zip code for Kansas City changes slightly. Similarly, for western states like California or Texas, the non-payment address is Ogden, Utah. Different zip.
And a different zip for payment to Ogden, too.
Exactly. Precise adherence to these specific addresses is genuinely crucial for proper processing. You don't want it getting lost or delayed.
Good point. Check those instructions carefully. Now, navigating all of this can certainly feel daunting. What kind of support does the IRS offer for fiduciaries trying to figure this out?
Well, thankfully, the IRS does offer a wealth of resources. The main hub, of course, is irs.gov. You can download all the forms, instructions, publications directly from there. Key publications that are particularly useful include Pub 559.
559.
Yeah, that's specifically for survivors, executors, and administrators. And Pub 550, which covers investment income and expenses. These often give much more detail than the form instructions alone.
Good resources to know.
Definitely. Beyond just forms and pubs, if a fiduciary runs into really tricky tax issues or systemic problems they can't solve through normal channels, they can reach out to the Taxpayer Advocate Service, or TAS.
Yes.
Yeah, their website is taxpayeradvocate.irs.gov, or they have a toll-free number, 877-777-4778, that can be really helpful.
Okay.
And it's also incredibly important for fiduciaries to understand their rights when dealing with the IRS. These are clearly laid out in the Taxpayer Bill of Rights.
Where do you find that?
Also on the TAS website, taxpayeradvocate.irs.gov, taxpayer rights. Knowing these rights is really foundational knowledge for any interaction with the IRS. It empowers you.
That's reassuring that there's support available. But of course, what happens if things don't go smoothly? What are the consequences of, say, filing late or not paying on time?
Well, the IRS does impose penalties, and they can add up, which definitely incentivizes timely and accurate filing.
Yeah, I bet.
For late filing, the penalty is generally half of 1%, 0.5% of the unpaid tax for each month or part of a month the return is late.
Okay.
This penalty is capped at a maximum of 25% of the unpaid amount shown on the return. For late payment of tax, there's also a separate penalty, typically half of 1%, 0.5% of the unpaid amount for each month or part of a month it's unpaid, also capped at 25%.
So penalties for both late filing and late payment.
Correct. And these penalties are in addition to any interest charges that accrue on late payments. So the financial incentive to file and pay on time and accurately is quite strong.
Definitely worth avoiding those. All right, let's roll up our sleeves and get into the actual numbers. We're on Form 141, looking at the income section. Before we dive into specific lines, are there any general income principles that apply here that are different from individual taxes? This feels like a core difference.
Yes. There are a couple of crucial concepts unique to these entities. First, for estates and non-grantor trusts, we talk about adjusted gross income, or AGI, but it's calculated differently than for an individual.
Okay, a special AGI.
Think of it as a specialized entity income that accounts for its unique operational costs. For these entities, AGI is total income minus very specific items. Certain administration costs unique to managing the estate trust, the income distribution deduction for income passed to beneficiaries,
Right.
the personal exemption amount, and any net operating loss deduction. This AGI computation is unique and directly impacts various other calculations on the return.
Got it. What's the second concept?
The second key concept, especially vital for estates, is income in respect of a decedent, or IRD.
IRD. Heard of that. What is it exactly?
It's income the decedent was entitled to receive, but hadn't actually received or properly included on their final individual tax return before they died. Often happens with cash basis taxpayers.
Like unpaid salary or maybe IRA distribution.
Exactly. Deferred compensation, IRA distributions, accrued interest, or dividends not yet paid at death. Common examples. The crucial point about IRD is that it's taxable to whoever receives it, either the estate itself or the beneficiary who gets it when it's finally received.
Okay.
And importantly, if estate tax was paid on that IRD amount, the recipient might be able to claim a specific income tax deduction for that portion of the estate tax. Helps prevent double taxation.
Ah, good to know. That's a great setup. Let's walk through the income categories on page 1 of Form 1041 now, line by line, starting with the basics, line 1 for interest income.
Right. Line 1 is where the estate or trust reports all its taxable interest income. Pretty straightforward, much like on a 1040, bank accounts, bonds, that kind of thing.
Okay. And then we move into dividends, lines 2A and 2B. This often holds a strategic advantage, right, for certain types.
Indeed, it does. Line 2A reports total ordinary dividends. Line 2B specifically reports qualified dividends. And here's a significant tax-saving strategy. Qualified dividends.
Lower tax rates.
Generally taxed at the more favorable long-term capital gains rates, yes.
Yeah.
Often lower than ordinary income rates, especially for estates and trusts which hit higher tax brackets very quickly.
Right, compressed brackets.
Exactly. So if the estate or trust has a net capital gain or qualified dividends and any taxable income, the fiduciary should absolutely use Schedule D, Form 1041, or the qualified dividends tax worksheet to figure the tax.
Don't just use the tax tables.
No, definitely calculate it properly. Doing so will almost always result in a lower tax bill for the entity. It's a direct, meaningful reduction in the tax burden. Don't miss that.
Great tip. That's a direct reduction in the tax rate.
Yeah.
What if the estate or trust is actually operating a business? That sounds like it adds complexity.
For business income or loss, reported on line 3, it is indeed handled by first completing Schedule C, Form 1040, profit or loss from business.
So you do a separate Schedule C.
Yes. All the detailed business revenues and expenses are calculated there, and then only the net profit or loss from that Schedule C gets transferred directly to line 3 of Form 1041.
Keeps the business details separate.
Right. It integrates the net result into the estate's or trust's overall income picture.
And capital gains or losses on line 4. Usually a separate schedule for individuals, too.
Correct. Capital gains or losses, whether from selling stocks, real estate, other capital assets, require Schedule D, Form 1041. That's where all sales and exchanges of capital assets get reported.
Okay.
Now, here's a powerful tax deferral and saving opportunity that's become increasingly relevant: investing in a qualified opportunity fund, or QOF.
Ah, the QOF program.
Yes, if the estate or trust has deferred a capital gain by investing in a QOF, it must file its return with Schedule D, Form 89949, Sales and Other Dispositions of Capital Assets, and Form 8997 attached.
Form 8997.
Right, the initial and annual statement of qualified opportunity fund investments. That Form 8997 needs to be filed annually until the QOF investment is sold.
So ongoing reporting.
Yes, but it provides a significant long-term planning opportunity to defer and potentially even reduce capital gains tax by reinvesting those gains into economically distressed areas.
That's a powerful strategy, definitely worth exploring if applicable. What about income from less direct sources, like rents, royalties, or interest in partnerships? Where does that go?
Those generally land on line 5. Income or losses from rents, royalties, partnerships, S corporations, other estates and trusts, Airmex,
Ramex.
real estate mortgage investment conduits. All that generally gets reported first on Schedule E, Form 1040, supplemental income and loss.
Another separate schedule first.
Right. And the net amount from Schedule E is then transferred to line 5 of the 1041. But there's an important nuance here for accurate categorization.
Okay, what's the catch?
If you receive income from a partnership, an S corp, or another flow-through entity, any interest, dividends, and capital gains from that entity should not be just lumped together and reported on line 5.
Where do they go then?
They need to be broken out and reported on their corresponding income lines on Form 1041. So interest from the partnership goes on line 1, dividends on line 2, capital gains on line 4.
Ah, okay. Keep the character of the income.
Exactly. It ensures proper categorization for later tax calculations and distributions. Very important detail.
That distinction is key. And if there's farm income
Yeah.
or ordinary gains or losses,
Farm income or loss, reported on line 6, is calculated on Schedule F, Form 1040, profit or loss from farming. Net profit or loss goes to Form 1041.
Schedule F for farming.
Right. Unless it's farm rental income based on crops or livestock produced by a tenant, that specific type goes on Schedule E, not F.
Little wrinkle there.
Tiny wrinkle. Ordinary gain or loss on line 7 comes from Form 47927, sales of business property, used for sales of business property or involuntary conversions.
Okay.
Finally, line 8 is the other income catch-all. For anything not specifically listed on lines 1, 2A, or 3 through 7. If there's more than one item, list them on an attached schedule. And here's a very important tax planning note. Always remember that certain types of income are not includable in gross income. They're not taxable.
Like what?
Well, certain death benefits received under Section 101 of the tax code, for instance, or interest on state or local bonds under Section 103, tax-exempt interest.
So don't accidentally report tax-exempt income.
Exactly. Scrutinize all income sources to identify any tax-exempt status. Correctly identifying these directly reduces the entity's taxable income and tax liability. Don't just lump everything into other income without checking.
Crucial point. Okay, we've navigated the income side, figured out where money comes in and how to categorize it. Now, for the part everyone loves, deductions.
Oh, yes.
This is where thoughtful planning can really make a significant difference for an estate or trust. How can fiduciaries strategically use these to minimize taxes?
This is indeed where the fiduciary's financial savvy really comes into play. The general rule for administration costs, which are often the biggest unique deductions for estates and trusts, is that they're deductible only to the extent they wouldn't have been incurred if the property weren't held by the estate or trust.
Okay, explain that. Wouldn't have been incurred.
It's a critical distinction from individual deductions. Think of it this way. If a cost is just a personal expense anyone might incur, it's probably not deductible here. But if it's an expense directly related to the unique responsibilities of managing an estate or trust,
Like paying the trustee.
exactly, then it often is deductible. Let's start with fiduciary fees, reported on line 13. These are allowable if they meet that not incurred by individuals test. They compensate the executor or trustee for their services.
Makes sense.
However, there's an important caveat and a key planning point. If any fiduciary fees were chosen to be deducted on Form 706, the estate tax return.
The estate tax return.
Right. They cannot be deducted again on Form 1041. No double dipping.
So you have to choose.
You have to choose. Fiduciaries must make a strategic decision. Deduct on the 706 against estate tax or on the 1041 against income tax. Whichever provides the greatest overall tax savings requires careful planning and coordination.
That makes perfect sense. Avoid a double benefit. What about professional fees, like for attorneys or accountants? Are those always deductible?
Attorney, accountant, and return preparer fees on line 14 are another key area. And here's a significant tax saving opportunity. Expenses specifically for preparing the fiduciary income tax returns, Form 1041.
Okay.
The decedent's final individual income tax return.
The final 1040.
Right. And all estate and generation skipping transfer, GST, tax returns are fully deductible.
Fully deductible? Why?
Because they're considered expenses that wouldn't have been incurred if the property weren't held in the estate or trust. They directly relate to the entity's tax compliance duties.
Okay.
However, just to clarify, expenses for preparing other tax returns, like gift tax returns, are generally considered common individual costs and are not deductible on Form 141.
So preparing the 1041 itself, yes. Preparing a gift tax return for the decedent, no.
Generally, that's right. It's always about the specific purpose. Is it administrative due to the unique nature of the estate or trust?
Got it. That distinction is really important. What about other miscellaneous expenses that might not fit neatly? Seems like there's a catch-all line that could hold significant deductions.
That brings us to other allowable deductions, line 15A. This is a broad category where, yes, careful analysis can yield significant deductions, but it often requires understanding some nuanced IRS guidance.
Like what? Give me an example.
Okay, appraisal fees. Deductible if they were incurred to determine fair market value for tax purposes, like a date of death valuation or a valuation for making distributions or for tax return prep.
Right.
But if the appraisal was for something else, like getting an insurance valuation on a painting, that's considered a common individual cost, not deductible on Form 1041.
Okay, purpose matters. What else?
Another common one, investment advisory fees. Generally, if these fees are for services commonly provided to any individual investor, basic portfolio management, they are not deductible on Form 1041.
Oh, really? That surprises me.
It surprises many people, but there's a key tax-saving nuance here. Incremental costs of investment advice beyond what's normally charged to an individual are deductible.
Incremental costs.
Yes. This specifically includes fees for services needed because of the unique complexities of a trust or estate, like balancing the potentially competing interests of current beneficiaries versus future remaindermen. That specific extra charge for fiduciary-level investment advice, that part's allowable.
That's subtle but important. What if there's just one big fee, a bundled fee?
Bundled fees. Good question. This happens when a single fee, like a trustee's commission, covers both deductible stuff, general admin, and non-deductible stuff, basic investment advice.
Right. How do you split that?
If the fee is not computed hourly, then only the portion attributable to the investment advice is not deductible. The rest of the bundled fee is generally deductible. Out-of-pocket expenses billed separately, like filing fees or travel, are treated distinctly. And for allocating that bundled fee, any reasonable method is allowed. Gives flexibility, but needs documentation.
Good to know. It's also probably important to know what not to deduct here, right? Avoid mistakes.
Absolutely. Explicitly what not to deduct on Form 1041. Medical expenses for the decedent and funeral expenses.
Where do those go?
Funeral expenses are only deductible on Form 706, the estate tax return. Medical expenses might be deductible on the decedent's final Form 1040, depending on timing and thresholds. Keeping these separate is key.
Okay, that's a comprehensive look at admin expenses.
Yeah.
Really highlights the specific nature. What about interest paid by the estate or trust? Any special rules or limits for line 10?
Yes, there are specific limitations on interest deductions. For instance, interest paid on debt used to buy or carry tax-exempt obligations, generally not deductible. prevents a double benefit.
Makes sense.
Also, personal interest like interest on personal credit cards or loans for personal use property, generally not deductible on Form 1041, similar to individuals.
But what is deductible?
Well, here's a tax-saving opportunity. Investment interest expense is deductible, though potentially limited.
How does that work?
If the estate or trust borrows money to buy investments that produce taxable income, the interest paid on that debt is deductible, but usually only up to the amount of the net investment income. You use Form 4952 to figure the limit.
Form 4952 for investment interest.
Right. Also, if the estate or trust has qualified residence interest on debt secured by a qualified residence of a beneficiary.
Oh, the beneficiary's home.
Yes, provided the beneficiary has a present interest or an interest in the residuary, that interest is deductible on the 1041. Specific benefit there.
Interesting. And state and local taxes, line 11?
Yeah.
We all know the $10,000 SALT cap on personal returns. Does that apply here too?
It does. The overall $10,000 limitation on deducting state and local income or sales, real estate and personal property taxes does apply to estates and trusts, just like for individuals.
Ouch. That can hurt, especially with real estate.
It can. However, there's an important exception to this cap. This $10,000 limit does not apply to foreign income taxes or to state and local taxes paid or accrued in carrying on a trade or business, or for the production of income by the estate or trust itself.
Ah. So taxes related to a business run by the trust or related to its investment activities can still be fully deducted.
Generally, yes. Those can bypass the $10,000 cap. Big difference if the entity has significant business or investment activity generating those taxes.
Good to know. What about passive activity losses on line 15B? Complex for individuals. Probably complex here too.
You're right. It remains complex. Passive activity losses are first subject to at-risk rules. Then the passive activity rules apply. Limits how much loss you can claim.
But any special breaks for estates?
Yes. Here's a specific strategic opportunity unique to estates. For an estate ending less than 2 years after the decedent's death.
Okay, specific time frame.
Right. Up to $25,000 of deductions and credit equivalents from rental real estate activities are allowed if the decedent actively participated in those activities before death.
$25,000 allowance.
Yes. Any excess losses or credits get suspended and carried forward. But that initial $25,000 allowance can be a powerful way to reduce taxable income early in the estate's administration.
Very specific, but potentially powerful. Now let's talk about a big one. The qualified business income, or QBI deduction. Huge for individuals lately. How does this path-through deduction work for estates and trusts? Seems like it could get complicated.
That's an excellent question. The QBI deduction is indeed a substantial benefit. And yes, estates and trusts can claim the QBI deduction. They use Form 8995 or 8995A.
8995 or 8995A.
Right, based on their qualified business income, REIT dividends, or publicly traded partnership income.
So how does it work? Let's do that deep dive.
Okay, deep dive into QBI for estates trusts. First, what's a qualified trade or business? Generally, any Section 162 trade or business, but it excludes specified service trades or businesses, SSTVs.
SSTVs like doctors, lawyers, accountants.
Exactly. Health, law, accounting, consulting, financial services, athletics, performing arts, or any business where the main asset is the reputation or skill of employees owners. QBI deduction generally doesn't apply to income from SSTVs.
Unless.
There's always an unless.
Right. Unless the beneficiary's individual taxable income is below certain thresholds. We'll come back to that.
Okay. What about rental real estate? Can that qualify for QBI?
Yes, rental real estate can qualify as a trade or business for QBI, but it has to meet specific criteria. It needs to rise to the level of a Section 162 trade or business.
But it can be a high bar?
It can be. Or it can satisfy the rental real estate safe harbor in IRS Revenue Procedure 2019-38 that requires specific records and activity levels. Or meet the self-rental exception. Importantly, the trust or estate itself makes this determination. Does the rental qualify?
The fiduciary decides.
Right. Before passing the info to beneficiaries.
Yeah.
Now back to that SSTB exception. This is absolutely crucial for beneficiaries.
Okay, tell me more. While the trust itself might not get a QBI deduction from an SSTB if its income is too high, if a beneficiary's individual taxable income is below or within certain phase-in ranges.
What are the ranges for 2024?
For 2024, it's below $191,950 for single filers, or $383,900 for married filing jointly, with phase-ins above that. If the beneficiary's income is in that range, QBI from an SSTB may be usable by them for their QBI deduction.
Wow. So the trust needs to tell the beneficiary, hey, This income is from an SSTB.
Absolutely vital. The fiduciary must identify any SSTB-related items on the statement attached to Schedule K1. Even if the trust gets no QBI benefit, the beneficiary might. Clear communication is key here for the beneficiary's tax planning.
That's a highly nuanced point with big implications. Okay, almost done with deductions. What about the exemption amount on line 21? Seems straightforward but varies.
It does vary significantly, again highlighting why correct entity classification is key. A decedent's estate gets a $600 exemption.
$600 for estates.
Trusts required to distribute all income currently, simple trusts get $300.
$300 for simple trusts.
Qualified disability trusts get a much larger $5,000 exemption, not subject to phase-out. Big benefit there.
$5,000 for QDTs.
And all other trusts, complex trusts, get just $100.
Only $100 for complex trusts.
Right. So understanding the governing document and trust type is key to claiming the correct, albeit sometimes small, exemption.
Okay, one more critical area for savings, especially when things wrap up, NOLs and excess deductions.
Yes, net operating loss, NOL carryovers, and excess deductions on termination. This is a powerful way to avoid wasting deductions.
How does it work?
If an estate or trust terminates, any unused NOL carryovers that the entity could have used in later years are passed through to the beneficiaries succeeding to the property.
The beneficiaries get the NOL.
Yes. They can use it on their individual returns. Direct tax benefit uses up the loss. Similarly, if the estate or trust has deductions, excluding charity and the exemption, that exceed its growth income in its final year.
More deductions than income.
Right. These excess deductions are also allowed to the beneficiaries. They can deduct them on their individual returns.
Great way to pass on benefits. Any catches?
An important caveat. Because of Section 67G, those miscellaneous itemized deductions subject to the old 2% floor, they're suspended from 2018 through 2025. So those specific types generally can't be passed through as excess deductions during this period.
Okay, so not all excess deductions.
Not the suspended miscellaneous itemized ones. Fiduciaries need to clearly tell the beneficiary what type of excess deduction it is. Is it deductible above the line towards AGI? Or a non-miscellaneous itemized deduction, so the beneficiary knows how to use it.
Communication is key again.
Always. And one small point. While unused NOLs generally can't also be treated as excess deductions, if the final year of the trust is also the last year of the NOL carryover period, any remaining NOL is included as an excess deduction. Ensures nothing is wasted if possible.
That's powerful. Ensures deductions aren't lost. Okay, we've covered deductions thoroughly. Let's talk credits. Deductions reduce income, but credits cut the tax bill directly, dollar for dollar. What should fiduciaries look for on Schedule G?
You're right, credits are golden. Dollar for dollar reduction. Key ones on Schedule G. First, the foreign tax credit on line 2A.
For taxes paid to other countries.
Exactly. Income or profits taxes paid or accrued to a foreign country or U.S. territory. It's limited to the estate's or trust's share not allocated to beneficiaries. Usually requires Form 1116. Prevents double taxation.
Okay, what else?
The general business credit, line 2B. This isn't one credit, but a bundle of various business-related credits.
Like research credits, WOTC.
Yeah, research credit, work opportunity credit, low-income housing credit, many others. If the estate or trust has activities generating these, they flow through Form 3800.
Form 3800 for GBC.
Right. There are others too, like credit for prior year minimum tax, Form 8801, bond credits, Form 8912. The key is just diligence. Does the entity qualify for any credits? Claim them.
Definitely worth looking for. Now, let's talk estimated tax payments on line 10. This feels like a big planning area, especially with large distributions.
It absolutely is. This brings us to a crucial tax planning election under Section 643G.
Section 643G. What does it do?
It lets the trustee or the executor in the final year of an estate treat any portion of the estate's or trust's estimated tax payments as if they were actually made by a beneficiary or beneficiaries.
Wait, you can push the entity's estimated payments down to the beneficiaries?
Essentially, yes. The benefit is enormous. It's a powerful tool for managing the overall tax burden. Think about it. Trust gets a big chunk of income late in the year, makes a big distribution. Income flows to beneficiaries.
Who might not have paid enough estimated tax themselves.
Exactly. They could face underpayment penalties. By making this 643G election, the fiduciary can assign some of its payments to those beneficiaries, potentially covering their liability. Optimizes the whole situation.
That's incredibly useful. How do you make this election?
The process is using Form 1041T, and here's the critical part. It must be filed by the 65th day after the close of the trust's tax year.
The 65-day rule again, like March 6th for calendar year trusts.
Precisely. March 6th deadline. It is absolutely imperative to meet this deadline. Miss it, and the election is invalid.
What happens then?
You'd likely have to file amended Schedule K-1s for all affected beneficiaries. Huge hassle. Negates the whole planning benefit. Mark that deadline.
Critical deadline. Got it. And a quick distinction.
Yes, important distinction. Estimated tax paid by an individual before they died. That goes on their final 1040. Not on the estate's Form 1041. The estate's payments are totally separate.
Okay, clear separation. That 65-day rule for estimated tax is a vital planning window. What about other payments or withheld taxes that might show up?
On line 13, you report tax paid with Form 7004, the extension request. Line 14 is for federal income tax withheld.
Withheld from what?
Could be from a decedent's final wages received by the estate, gambling winnings, maybe distributions from pensions, annuities, IRAs received by the entity. You'd attach the W-2, W-2G, 1099-R to support the claim.
Right. Can this withholding be passed to beneficiaries?
Generally, no. Regular federal income tax withheld, except backup withholding, cannot be passed through to beneficiaries on Schedule K-1 or Form 10041T. Common misconception.
But you said exempt backup withholding.
Right. Backup withholding, the kind that happens if you don't provide a correct TIN, for example, can be claimed on Form 1041 if the income stayed with the entity. Or it can be passed through to beneficiaries via Box 13, Code B, on Schedule K-1 if the income was distributed. Specific important exception there.
Good detail. Okay, we've covered a lot on mechanics, income deductions, credits, payments. Let's shift to some special considerations, critical questions on Form 1041. Starting with foreign financial accounts. This gets really interesting in our global world. What's crucial here?
It certainly does get interesting, and this is an area with huge penalties for noncompliance. Easy for fiduciaries to miss. On Schedule G, Question 3, you have to check yes and name the country if.
If what? Two conditions.
Right. If the estate trust owns more than 50% of stock in a corporation that owns foreign bank accounts. Or, second, if at any time during the year the estate trust had an interest in or signature authority over a bank, securities, or other financial account in a foreign country.
Brokerage accounts too.
Yes, brokerage accounts, mutual funds held outside the U.S.
Is there a minimum amount?
Yes, there's a key threshold and exception. You can check no if the combined maximum value of all foreign accounts was $10,000 or less throughout the entire year, or if the accounts were with a U.S. military banking facility.
$10,000 threshold. But if it's over that, or you meet the other tests, you check yes.
Correct. And if yes is checked, here's the crucial compliance and severe penalty warning. The fiduciary must electronically file FinCEN Form 114, the FBR.
FBR, filed with the Treasury, not the IRS.
Exactly. Filed with FinCEN.gov, the Financial Crimes Enforcement Network, not with Form 1041, and failure to file the FBAR or filing it incorrectly can lead to severe penalties.
How severe?
Potentially $10,000 for non-willful violations, significantly more, even criminal penalties for willful violations. Strict compliance here is absolutely vital. Don't overlook the FBR.
Significant warning. Good reminder that not all reporting goes to the IRS. Okay, speaking of modern finance, what about digital assets? Very contemporary question on the form. How are digital assets defined, and what's a financial interest requiring reporting?
Yeah, this is new and evolving. For Schedule G, Question 13, the IRS defines digital assets broadly. Any digital representation of value recorded on a cryptographically secured distributed ledger or similar tech.
So crypto like Bitcoin?
Yeah.
NFTs?
Yes. Includes non-fungible tokens, NFTs, virtual currencies like cryptocurrencies, Bitcoin, Ethereum, and stablecoins. If it has those characteristics, it's likely a digital asset for tax purposes.
And what's a financial interest in one?
Generally means the estate or trust is the owner of record or has an ownership stake in an account holding digital assets, including rights to acquire, or owns a wallet holding them, captures ownership or control.
Okay. But what doesn't trigger a yes? Seems like routine stuff might get caught.
Good point. There's crucial clarification for common transactions to ease anxiety. Simply holding a digital asset in a wallet.
Just holding it.
Right. Or transferring a digital asset between wallets the estate trust already owns or controls.
Moving it from one of your wallets to another.
Exactly. Or purchasing digital assets using US dollars or other real currency, even via PayPal or Venmo, generally do not require you to check yes on this question.
Ah, that helps. So it's more about acquiring a new interest, not just managing existing assets or buying with cash.
That seems to be the intent. Helps avoid over-reporting for routine activities.
That's incredibly helpful. Okay, beyond specific assets, are there any broad strategic tax planning elections fiduciaries should know about on Form 1041? Big flexibility points.
Yes, two powerful elections on Schedule G offer significant planning flexibility, critical for optimizing tax outcomes. First, the Section 663B election at question 6, often called the 65-day rule.
Another 65-day rule. What does this one do?
This allows fiduciaries of complex trusts or decedents' estates to treat any amount paid or credited to a beneficiary within 65 days after the end of the tax year as being paid or credited on the last day of that preceding tax year.
So we make a payment in January or February, but treat it as paid last December.
Exactly. It's a superb tool for income smoothing and tax management. Imagine a trust gets big income late in December. Normally, a January distribution would be taxed to the beneficiary in the current year.
Right.
But with the 65-day rule election, the trustee can make that January distribution, but elect to treat it as distributed in the prior year, usually done to shift income to beneficiaries in a lower tax bracket than the trust. Reduces the overall family tax bill.
Smart planning. Is it revocable?
No. Once made, this election is irrevocable for that year. Requires careful consideration.
Okay. What's the second big election?
The Section 643 election at question 7. This election lets a trust or estate recognize gain or loss when it distributes property in kind to a beneficiary.
Property, not cash.
Yeah.
Like distributing stock.
Exactly, like distributing appreciated stock. By default, distributing property in kind generally does not trigger gain at the trust level. The beneficiary takes the trust's original basis, carryover basis.
Right.
But by making this election, the trust chooses to recognize the gain or loss as if it had sold the property at fair market value on the distribution date.
Why would you want to recognize gain?
Provides powerful flexibility. Maybe the trust has capital losses it can use to offset that gain. Or maybe recognizing the gain at the trust level, perhaps at lower rates, is better than the beneficiary getting a low basis. It allows strategic management of gains, losses, and bases. Key decision point.
Those elections really show the strategic choices available. Finally, let's talk about the beneficiary's journey. How does Schedule K-1 tie it all together? How does it make that pass-through concept work in practice?
Schedule K-1, Form 1041, is truly the critical link in that pass-through chain. It's the essential form the fiduciary uses to tell each beneficiary their specific share of the entity's income, deductions, credits, other tax items.
The information conduit.
Exactly. It directly translates the entity's activity into what the beneficiary must report on their own individual 1040. Without it, the beneficiary is flying blind.
What kind of details are on the K-1?
It itemizes things specifically. Box 1 reports their share of interest income. Box 2A, total ordinary dividends. Box 2B, the qualified dividends helping them get that lower rate.
Right.
Box 3, net short-term capital gain, and so on. And critically, specific boxes and attached statements provide all that qualified business income QBI deduction information we discussed.
So this isn't just info. It directly leads to tax savings or obligations for the beneficiary. Completes the pass-through.
Precisely. Direct tax savings and implications flow from the K-1, especially when an estate or trust terminates. For instance, unused capital loss carryovers.
From the terminating trust.
Yes. Reported in Box 11, Codes C and D. Upon termination, any capital loss carryovers the entity couldn't use get passed through to the beneficiaries succeeding to the property.
So they can use those losses on their 1040s.
Exactly. Offset their own capital gains, or up to $3,000 a year against ordinary income. Prevents valuable tax losses from just vanishing.
Great benefit. What else passes through a termination?
Excess deductions on termination. Box 11, Codes A and B. If the entity's deductions, excluding charity exemption, exceed its gross income in the final year, these excess deductions also go to the beneficiaries.
Again, preventing wasted deductions.
Right. But remember that important note. Due to Section 67G, suspending those miscellaneous itemized deductions, 2% floor ones, through 2025. Those specific types generally cannot be passed through as excess deductions during this time.
So the K-1 needs to be specific about the type of deduction.
Absolutely. The fiduciary needs to tell the beneficiary, is this excess deduction deductible above the line? Is it a non-miscellaneous itemized deduction? So the beneficiary knows how to properly claim it.
Clear communication strikes again.
And finally, that QBI information, Box 14, Code 1, and its statement. Extremely important. It gives beneficiaries their share of QBI, W-2 wages, qualified property info, and crucially identifies any SSTB items.
So the beneficiary can figure their own QBI deduction, even if the SSTB income didn't help the trust.
Exactly right. That statement empowers the beneficiary to maximize their own potential QBI deduction based on their individual circumstances.
So after this really deep dive into Form 1041, What does all of this ultimately mean for our listener? Connect the dots for us.
Well, if we connect this to the bigger picture, it means that while Form 1041 might seem like this, highly specialized niche tax form,
Yeah, kind of intimidating.
right. But its instructions are actually packed with specific rules, detailed definitions, and critically, just abundant opportunities for really astute tax planning. Understanding the unique income, deduction, credit, election rules that apply specifically to estates and trusts. That can lead to significant tax efficiencies, real wealth preservation.
For both the entity and the beneficiaries.
Exactly. It's about knowing not just what to report, but how to report it most advantageously, truly optimizing those financial outcomes.
This really goes way beyond just filing a compliant form, doesn't it? It's about being a strategic guide, optimizing financial outcomes, preserving wealth across generations.
Indeed. It powerfully highlights that tax compliance in this area isn't just about rigidly following rules. It's about understanding where the law allows for flexibility, where strategic, informed choices can be made to preserve and grow wealth.
A big responsibility for fiduciaries?
It is. For fiduciaries, it's about a deep engagement with both the governing documents, the will, the trust, and the tax law to truly serve the best financial interests of the entity and its beneficiaries. It's a responsibility that carries significant power to impact financial legacies.
And as we wrap up this deep dive, maybe consider this provocative thought for you, our listener. Considering the surprising facts we've uncovered today about how these entities and their beneficiaries interact with the tax code, how might a deeper understanding of these specialized rules empower you to think differently about long-term wealth transfer strategies and family financial legacies, even if you're not directly a fiduciary right now? Perhaps it's about asking better questions of your own advisors, or maybe seeing potential pitfalls and opportunities with, fresh eyes. Thank you for joining us on this enlightening deep dive into Form 1041. We hope you found it as fascinating as we have.
We definitely encourage your continued curiosity and exploration of these complex but honestly immensely rewarding topics. Until next time.